are now into Unit 5. So we're looking at credit. So in the 5.1 folder on Schoology, okay, this first presentation is just, you can see it's just on basics of credit. So what it is, how it works, types of credit, and then considerations to keep in mind when you're thinking about using credit. Credit is just the ability to buy something now and pay for it later, right? So in the example of the student loans, right, we borrow money now, so we purchase that college education now, and then we pay for it over the next 8, 10, 15 years, right? When we use a credit card, we use the bank's money or the credit card issuer's money, right? Visa, MasterCard, whatever. If you get it through your your bank or Capital One's money, whatever. Okay. You're using their money to make purchases, and then you have to pay them back in the future. All right. And so that's all credit is getting something now and then paying for it in the future. All right. And so this goes through the first several slides, just give some information about how prevalent credit usage is in our culture. All right. We are a very consumerist culture. We're a very materialist culture. And for the majority of Americans, that means that we are spending more than we're earning. All right. So the majority of Americans owe money. They have debt. Okay. So as I said, the first few slides go through just some facts that help to demonstrate how widespread credit usage is. Again, a brief introduction description of what credit is, but then it'll go into types of credit, installment, revolving, okay, consolidations. It talks about advantages and disadvantages. Okay, there are a couple of videos that help to hopefully, in a light way, talk about some of these issues. And then it talks about the interest, right? And interest is a huge thing. When you're taking into account whether or not to purchase something on credit. All right. We will use this simple interest formula, which is simply the interest that accumulates is the principal, the amount that you borrow, times the interest rate times time, right? Most interest isn't actually calculated this way. This is a very simple way to do it because of compounding interest, in which, if I borrow, let's say I borrow $10 today, right? And it's at a 10% interest rate. That means over the course of a year, $1 will accumulate in interest, right? 10% of the amount that I borrowed. So I borrowed $10 at 10% annual interest rate, annual meaning yearly. That means 10% gets added onto it. Right. So 10% of $10 is $1. So at the end of the year, $1 of interest is accumulated. I now owe $11. All right. Well, compounding interest means that if I still continue to owe money, interest accumulates not just on what I borrowed, but also accumulates on the interest that accumulates. So I started out the first year, I borrowed $10. At the end of that first year, I now owe $11. 10% interest means at the end of the second year, I owe 10% extra, not just on the 10 that I borrowed, but also on that dollar that accumulated on interest. So I owe 10% on the $11 that I owe, not just the 10 that I borrowed. So now 10% of that is $1.10. So instead of just going up by $1 to $12, I now owe $12.10. Okay, might not seem like a lot, but when we're borrowing thousands of dollars, tens of thousands of dollars, right? That compounding interest does kick in and does factor in quite a bit. The positive thing about compounding interest is that it works the other way as well. When you save money, when you invest money, okay, when you earn interest on that interest also compounds as well. Okay, so it's great for saving and investing. It's really bad when you're the one that owes the money rather than saving the money. The simple interest formula, though, is just kind of a rough way to get a general sense of how much interest can accumulate. It's not perfect because usually interest compounds in credit cards sometimes, in a daily fashion. In some loans, it compounds quarterly or semi-annually, right? So anyway, it is still useful in a sense. This, when it gets to it, this amortization formula, this is really how interest is accumulated and calculated. I'm not going to have you memorize this or really understand it right now. But the big thing about this is that it can be used for really large purchases like a home loan, like a car loan. And so you can forecast exactly how much interest will accumulate over the life of the loan. and then work in those the kind of repaying interest into the payments. So you can see here on this chart, this is an exaggeration, right? $100 at 40% is insanely high, but right. You could use that table to see that $11.96 would accumulate on interest, okay? Because you're paying some of it off while the interest is accumulating, but then the interest is also accumulating and compounding. Anyway, the point is that you're paying this off in 6 installments. You can see that as you pay the total down, so every payment you're paying down what you owe, the payment amount stays the same, but the amount going to the part that you borrowed goes up, and a portion of your payment going toward interest is going down, but it works out so that each payment stays the same. Again, this is a little bit more advanced than what we're going to deal with in this class, but I just want to show this to you because someday in your life, you're going to probably talk about this when you are borrowing money for a car loan or a home loan. They might talk about, the lender, the banker might talk about amortization. That's what that is. All right. But for our purposes, when we're talking about interest, if I ask you to calculate interest, I will either direct you to an online interest calculator. So we'll either use online tools or we'll use this simple formula. All right. But again, I'm going to let you go through this presentation. I touched on kind of the broad aspects of it, but I'll let you go through this on your own. Remember, my recommendation is just to view the presentation embedded right on Schoology, okay, by clicking on the within the window and then just using your arrows or whatever, okay. You'll see all of the animations, so you'll see it presented in the order that you should. If you just go slide to slide, okay, it just pops everything up at once, which is convenient at times, but then you get to something like that, and all of a sudden you went from slide 41 to 42, and now you can't read it because you didn't do the animations, because you didn't allow the word, the text to come up before the graphics. Okay. Similarly, if you want to pop it out so you can make it full screen, you put it into this view. Again, if that's all you do, you can't see what's on there. So if you want to make it full screen or make it larger and you click that pop out, right, just make sure that you go to present then so that you can actually see everything, because then it'll come up, in sequence. All right, so go through that presentation, and then you've got this one worksheet. It's called the 5.1 Basics of Debt. What you're going to do is take the information and the knowledge that you gained from the presentation, and then read this one-page article and use that as well. Okay, this summarizes some of the main points that's in the presentation. I've embedded it right here so you can read. It is attached down below if you'd rather download it and open it up as a PDF to make it larger. It's also linked right here, but you can click that to open it up, and then obviously it's going to be a much larger view, and then you can control it a little bit more in terms of how large or small you need that. You can see here, this is like a one-page summary that touches on some concepts that are taken from this Wall Street Journal book about personal finance. So there's a whole section in that book about credit and debt. This just summarizes some very key points. All right, so you're going to read that one-page article, whether you read it straight from the Schoology assignment page, whether you click that link, or whether you download it as a PDF and open it up. Read that article, won't take you very long, and then here's the link to the worksheet. Okay, just one page, 7 questions. Make sure you turn that in, and that's all that we need to get done for today. All right, so get on that. We'll talk about this worksheet tomorrow. We'll go through it. As you're going through the presentation, I think credit is one of the topics that a lot of students are really interested in, because I think it's one of the first things that high school students really are aware of but don't have yet, right? Most of you have bank accounts, whether it's a checking account or savings account. You might have a debit card, right? You're starting to really kind of become habitual users of that. Investments, insurance, that's kind of down the road. Buying a house, that's down the road. This credit is really kind of the next stage of your life in terms of money experiences and handling money. And so I think a lot of students get really excited or interested about this unit. So if you have questions, or if there's anything that is unclear or that just doesn't make a lot of sense, or you would like some clarification on it, absolutely reach out to me. Let me know. I'll be happy to explain any of this in more detail. But otherwise, I'll let you go through this. Okay, do the note sheet, go do the presentation, read that article, do the worksheet, get that turned in. We'll see you tomorrow, everybody.